Here's your closing bell.
That was aggressive.
That was aggressive. Lots of excitement there. Lots of happiness, it looks like, on that following what has been a brutal day for the markets. But we'll take it because, Dave, like you said to start the show, we're looking for any sort of optimism today. That
hammer is exactly what happened to the market today.
That is good. Yes, that
it
hammer
was
is
aggressively
exactly
hammered
what
downward.
happened. You can see it reflected on your screen. The Nasdaq, the worst performer of the three major averages. Larger cap tech names leading to the downside here. The worst performers in the market. S&P off about 2.5%. The Dow off 763 points. The worst performance that we've seen for the Dow since September. Let's take a closer look at some of these losses, what it means for the coming weeks. We want to bring in Sam Stovall, Chief Investment Strategist at CFRA Research, and also Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree. Sam, to you first, just in terms of the sell-off, the magnitude of the sell-off today, what we heard from Jay Powell yesterday, any sort of overreaction, or were you expecting this type of selling today?
Well, no, I was not expecting this kind of a selling, but I think what it reflects, it's sort of like a deflating Santa Claus lawn ornament that tends to reflect the diminishing investor optimism that the U.S. will avoid a recession. So I think that's what's happening is investors were thinking that the Fed would say something a little less hawkish, maybe even hint at the end of the rate hikes by early next year, the first rate cut by the end of next year, and they got none of that. And so what they're doing is reverting back to a more defensive posture.
Kevin, it's interesting. Jerome Powell has been remarkably consistent throughout most of this tightening cycle and was yesterday. It's almost as if the markets weren't listening and finally heard what he said. What do you make of it?
Well, I think for the bond market, especially for the Treasury market, they're not essentially buying what Powell's trying to sell them at this stage of the game. I mean, his comments have been, as you mentioned, very consistent. And I think the fact they raised the dot plot, so the median estimate for Fed funds to 5.1%, it's kind of remarkable to see just front end treasuries not responding at all. I mean, if you look at a Treasury 2-year yield at 4.25%, we're essentially underwater now. We're under, for the most part, the current trading range for Fed funds, which is essentially unprecedented. So I do think this disconnect is somehow going to resolve itself, I think perhaps after the holidays, that if we continue to get numbers, I know retail sales, as you mentioned earlier, were certainly on the disappointing side, but jobless claims, that's what the Fed's focusing on, the labor market. Jobless claims fell to their lowest level, I think, since September. So labor market demand is still there. And Powell, I think, made it pretty clear. I think that's the new indicator we should be looking at.
Sam, what does this mean for the market then in 2023? Because certainly sets us up for a very challenging couple of months.
Yeah, I think that what we're likely to see is a first half that is very different from the second half. I think we do end up seeing the Fed raise rates by 50 basis points in February, another 25 in March. I think we do tend to retest the October 12th low and maybe even set an even lower low. But I think beyond that, investors are going to be looking across the valley and realizing that on average, the Fed has started to cut interest rates about 8.5 months after their final rate hike. So that would put us squarely into December. So with the Fed reminding us that they are data dependent, should we end up with a weaker than anticipated response by the economy, I think the Fed will have to shift course.
Kevin, you mentioned that renewed emphasis on the labor market, on services, on wage growth. Do you think a terminal rate just north of 5 will actually break that labor market? We've seen zero softening thus far.
No, I don't think it breaks the labor market. I think what the Fed is looking to do is to just slow it, right? I mean, just from a political perspective, it'd be tough for him to testify on Capitol Hill that was their goal. But I think what the Fed's trying to do is to continue to soften the demand side of the ledger. And as we go forward, what Sam was saying, I think that's a very likely or reasonable case scenario that the Fed does get us to that new dot plot of, say, roughly 5%. for lack of a better way of saying it, and then, in fact, considers perhaps, behind me here, maybe Powell, instead of coal, put something good in that stocking a year from now.
And Sam, despite this challenging setup, we know that the consumer has remained very resilient, yet we got that retail sales number weaker than expected, a bit concerning here for investors. Do you think that trend, I guess, is starting to shift? And what does that mean for the retail sector or some of those consumer discretionary names?
Well, what's interesting is that you would think that it would cause the consumer discretionary group to really head south. But if you look at a relative strength chart of the S&P equal weight consumer discretionary group versus the market itself, you're actually seeing that it came off its bottom of June of 2022 and is working its way up to the point where it's now pretty close to being on par with the market on a rolling 40-week basis. So I think that there is optimism that the consumer will be able to withstand this. What they're doing is they're pulling back because of the concerns that they hear about, that they read about, et cetera. But with the employment picture still looking so healthy, they do end up having the money to spend.
Kevin, anything just to end this, hopefully on a positive note, anything that we should be optimistic about at this point?
Yeah, I mean, I do think that if there was any silver lining in the bond market, it's that the worst year perhaps on record for fixed income is setting ourselves up for perhaps a pretty good year, maybe in the second half of 2023, once the Fed does go on pause and perhaps considers rate cuts a year from now, fourth quarter next year, say, that we could actually look back and say, hey, this wasn't such a bad year for the bond market. You have yield levels that a generation of investors have never witnessed before. So there's income back in fixed income.
All right, we'll leave it at that. Kevin and Sam, great to have you. Thanks so much for joining us this afternoon.